Every citizen assumes that the United States' financial system is unshakable. We assume the dollar is invincible, that Wall Street operates under unbreakable rules, and that scandals are minor bumps in a vast economic machine. Yet history proves that assumption dangerous. The United States has survived its share of financial catastrophes, moments when reckless ambition, unchecked greed, and political mismanagement nearly toppled the nation's economy. These are not abstract tales of the past. They are vivid warnings of how fragile even the mightiest economy can be. Long before the 2008 mortgage meltdown made headlines around the globe, there were financial storms brewing quietly behind the curtains of American history. Consider the Panic of 1792, the first real financial crisis of the new republic. George Washington's America was barely 10 years old, yet speculation and credit bubbles were already threatening the economy. Alexander Hamilton, the nation's first Secretary of the Treasury, had introduced policies that encouraged the development of financial markets, creating a system of bonds, banks, and government-backed securities. The problem was that humans, predictably, abused the system. Investors, many of them insiders, began trading on information unavailable to the public, betting recklessly on government securities, and inflating prices to levels that had no connection to actual economic value. When the bubble burst, banks teetered on the edge of collapse. Hamilton's intervention, temporarily injecting liquidity and ordering public confidence to be maintained, saved the system, but it came dangerously close to unraveling the nation's financial foundation. The lesson was clear. Even at the dawn of the American experiment, unchecked speculation could threaten the entire economy. Jump forward to the early 19th century, to the era of the Second Bank of the United States. Many Americans believed that a central bank would stabilize the economy, provide credit for growth, and prevent crises. What they underestimated was how political maneuvering could transform stability into chaos. President Andrew Jackson's fierce opposition to the bank led to the so-called Bank War, a battle of ideology, power, and finance. Jackson believed the bank favored the wealthy elite at the expense of ordinary citizens, and in 1833 he ordered federal deposits withdrawn from the Second Bank, redistributing them to smaller state banks. On the surface, it seemed like a moral victory for democracy. In reality, it triggered financial turmoil. These pet banks issued money liberally, fueling speculation in land and commodities. When the bubble burst in 1837, the nation plunged into a depression. Banks failed, land prices collapsed, unemployment soared, and ordinary Americans lost savings they had trusted would be secure. The collapse illustrated a timeless truth. Even good intentions, like preventing concentration of wealth, cannot prevent economic systems from being destabilized if human behavior and politics enter the equation. By the late 19th century, the United States had grown into a powerhouse of industry, finance, and ambition. But growth brought new vulnerabilities. In 1873, the so-called Panic of 1873 revealed just how interconnected and fragile financial systems had become. Speculators, overextended railroads, and banks teetering on excessive loans created a chain reaction. The collapse began with the failure of J. Cook and Company, a bank heavily invested in railroad bonds. When it failed, panic rippled through markets. Stock prices plunged, banks folded, and businesses went bankrupt. The depression that followed lasted years, and unemployment soared to levels unimaginable at the time. What is remarkable, and what few Americans today realize, is that this crisis nearly bankrupted the U.S. government itself. Revenues collapsed as taxes on industrial output fell, leaving the federal government scrambling to fund its own operations. This was a nation on the brink, saved only by a combination of emergency fiscal measures and sheer luck. It was a reminder that economic growth without prudent oversight and risk management can be just as dangerous as stagnation. Perhaps one of the most astonishing and least remembered financial scandals is the Teapot Dome scandal of the 1920s. Unlike panics triggered by banks or speculation, this was a scandal of corruption, government officials betraying public trust for private gain. Secretary of the Interior Albert Fall leased federally owned oil reserves in Teapot Dome, Wyoming, and Elk Hills, California, to private oil companies without competitive bidding. In return, he received personal loans, cash, and gifts worth hundreds of thousands of dollars, a fortune in the 1920s. When the scandal came to light, it shook the public's confidence in the government and the very institutions that were supposed to safeguard the nation's resources. While it did not cause a formal economic collapse, it exemplified a broader truth. Financial ruin is often less about market forces and more about human greed. Even in an economy as robust as the United States, corruption can corrode the system, and trust, the foundation of finance, can vanish almost overnight. The 1930s brought another, far more devastating test, the Great Depression. Millions of Americans have heard the headlines. Unemployment soared above 25%, banks failed by the thousands, and savings were wiped out. But what many do not understand is that the crisis was compounded by a series of smaller, often forgotten financial missteps and scandals that amplified its impact. Banks had engaged in risky lending practices, especially in the stock market. Margin buying, purchasing stocks with borrowed money, created a bubble that was bound to burst. Moreover, regulatory oversight was nearly non-existent. When the crash came in 1929, the domino effect was catastrophic. Banks collapsed, trust evaporated, and the federal government had neither the mechanisms nor the experience to intervene effectively. Franklin D. Roosevelt's New Deal eventually stabilized the system, but only after enormous social and economic costs. History shows that neglecting small risks, tolerating unethical financial behavior, and allowing unchecked speculation can accumulate until the result is a full-blown national crisis. Fast forward to the 1980s, when deregulation and financial innovation created opportunities and dangers that the country had never seen. The savings and loan crisis, though largely forgotten today, nearly cost the American taxpayer hundreds of billions of dollars. Over 1,000 S&L institutions collapsed due to reckless lending, fraud, and speculative investments in real estate. Many executives manipulated accounting records, misused depositor funds, and engaged in blatant self-enrichment. When the crisis peaked, the federal government had to intervene with emergency bailouts. Ordinary citizens were left stunned. The scandal revealed that even in an era of advanced oversight, loopholes, negligence, and human greed could push an entire sector to the brink of collapse. And, once again, those who trusted institutions blindly suffered most, while insiders who positioned themselves to profit emerged unscathed. No narrative of forgotten American financial scandals would be complete without mentioning the collapse of long-term capital management, LTCM, in 1998. LTCM was not a bank, it was a hedge fund. It was staffed by Nobel laureates, PhDs, and some of the brightest minds in finance. Its strategies were mathematically sophisticated and theoretically bulletproof. Yet, when unexpected market shocks, primarily the Russian debt default, occurred, LTCM's leveraged positions unraveled in days. The fund's failure threatened to destabilize global markets, prompting the Federal Reserve to coordinate a private sector bailout to prevent a systemic collapse. The lesson was profound. Even genius and quantitative rigor cannot eliminate risk entirely. Confidence and liquidity, human and institutional behavior, remain the ultimate arbiters of financial survival. When trust disappears, the brightest minds and the largest institutions can fail just as spectacularly as any speculative amateur. Finally, the story of Enron in the early 2000s serves as a chilling modern parallel. Enron was not a bank. It was a corporation that manipulated accounting rules to hide massive debts and inflate earnings. Executives misled investors, banks colluded, and auditors turned a blind eye. When the fraud collapsed in 2001, thousands lost jobs and savings, pension funds were devastated, and the ripple effects were felt across the economy. Enron's bankruptcy highlighted a recurring pattern in American financial history. Scandals often go unnoticed until the illusion shatters, and ordinary citizens bear the brunt while insiders escape or profit. Transparency, oversight, and skepticism, values often taken for granted, proved indispensable. From the panic of 1792 to Enron, the story is consistent. America's economy has flirted repeatedly with catastrophe, nearly undone by speculation, corruption, and mismanagement. These crises were not always obvious. They were often masked by confidence, rhetoric, and the illusion that the system was invulnerable. Yet, when the underlying flaws were exposed, the consequences were brutal. Ordinary citizens lost savings, livelihoods, and trust. Government scrambled to intervene, sometimes successfully, sometimes too late. And always, a few insiders, or those prepared to act decisively, seized opportunities while the majority suffered. The patterns are stark. Collapses are rarely caused by a single factor. They are the result of human behavior compounded over time: greed, ignorance, over-leveraging, and the assumption that institutions are infallible. They remind us that wealth, whether personal or national, is fragile. Real assets, liquidity, and skepticism have consistently proven their value, while blind trust in paper promises, institutions, or political assurances has consistently led to ruin. So, what is the lesson for Americans today? First, history is never distant. The same patterns that nearly bankrupted the United States in 1792, 1837, 1873, 1929, 1980s, and 2001 are still present, albeit in new forms. Markets are complex, regulators are imperfect, and human nature is unchanging. Second, preparedness matters more than confidence. Those who understand the system's fragility, who diversify assets, and who maintain reserves, liquid, tangible, or otherwise, are far more likely to survive shocks. Finally, skepticism is a virtue, not cynicism. Trust must be earned and constantly evaluated because financial collapse is never a question of if, but when. Every forgotten scandal, from Teapot Dome to LTCM, teaches a simple truth. The American economy is a human creation, and all human creations are vulnerable to error, ambition, and greed. Collapse is not a distant possibility. It is a recurring feature of history, and the difference between ruin and resilience lies not in hope or patriotic sentiment, but in preparation, foresight, and understanding the lessons embedded in the nation's financial past. The United States has survived these crises before, often by the narrowest of margins. The citizens who learned, adapted, and acted thrived. The ones who trusted blindly suffered. That pattern has repeated for over 2 centuries. History, when read carefully, is not just a chronicle of events. It is a guidebook. It whispers warnings about financial hubris, about the danger of illusions, and about the resilience of those who anticipate risks rather than ignore it. The question is not whether the next scandal will occur. It is inevitable. The only question is whether Americans will be among the many left holding empty promises, or the few who hold something real. History has already written the answers. It's up to us to read, understand, and act.